Are we recording? Yes, we are. I
Yes.
think I see a blinking red dot. Okay, cool. Welcome everyone. This is going to be a talk, part one of two, which is going to be about monetary policy and international trade. Is this the most boring topic in debating? Probably. Yeah, I would struggle to think of anything that people find less interesting than when emotion comes up that's about, I don't know, the euro or anything to do with, money or economics, and monetary policy is probably a particularly boring aspect of it. But it is it's useful. These arguments crop up in a variety of different debates, and I've seen a lot of debates about the euro that are really bad. And I think part of the reason why they're bad is a lot of people have read enough articles in the Economist, or seen enough things on Facebook that have vague statements like the euro has screwed over Southern Europe, or various things like that. Or they hear the word interest rates, but they don't necessarily know what that means. And so they know the right sort of like headline phrases to throw out, but they can't really do the explanations for them, or they don't really know when they apply, or things like that. And that's not really anyone's fault. I mean, it's not something we really get taught in school, and it's not something that most articles cover particularly well either, because most of the time the people reading them already know what all the terminology means, and there's very few good sources to acquire that understanding in the first place. Now, I will say, in the process of compiling this lecture, I noticed that at various points I was struggling to find ways to avoid using jargon. So there's a lot of kind of specific terminology, and I've done my best to explain it as I go through, and I'll also provide verbal explanations, but I want to be absolutely clear, and I'm going to pull up the chat now just to make sure that I can. Why can't I see the chat? Here we go. Cool. So I'm going to keep the chat open, and or just unmute yourselves if you want to ask a question. And I strongly encourage people to ask questions like whenever something's unclear, because if it's unclear to you, it's very likely that it's unclear for other people. So unless there's any questions before we get going, let's begin. All right. So what is monetary policy? Is that, yeah, that's the first slide, cool. What is monetary policy? So you can split the economic policy that governments and government institutions do into two branches. One of them is, and this is the one that most people are familiar with, most people know a lot more about, we tend to hear a lot more about, it's generally better understood, it's fiscal policy. So this is the government collects taxes and then they spend those taxes to do stuff, right? And when we might say that, fiscal policy can take the form of achieving social objectives. So, increasing welfare spending may have socially desirable outcomes. But in terms of economic management, most of the time we're talking about fiscal policy, we mean governments responding to economic shocks, or carrying out investments in order to promote economic growth, or just a variety of other things, generally being responsive to the changes in the economy and trying to spend money in a way that makes that as efficient as possible. The core aspect of all of that, though, is that the government is collecting money from somewhere, so taxes or from borrowing, and then they're spending that money. The other branch of economic policy management is monetary policy, and this concerns money, and critically it concerns the supply of money, the flow of money, and the availability of credit, i.e. how easy it is to get loans, how easy it is to borrow money. So monetary policy is conducted by central banks. So as most of us, I imagine, do, we live in Europe, and if your country is part of the euro or the eurozone, then your monetary policy is carried out by the ECB, the European Central Bank. If you live in the USA, it's carried out by the Federal Reserve. In the UK, it's the Bank of England. And every country with a currency, which is all of them, will have a central bank. And we'll talk about what they do and the kind of things, the tools they have at their disposal. But before that, it's worth considering, right? What is money? Because it's kind of an obvious question, but it's a term that gets thrown around in lots of different contexts, and I think it's worth clarifying and cleaning up the sort of specific definitions of what money is and what money isn't. So money is anything that holds value and is recognized as a generally accepted means of payment for goods or services. So back in the day, apparently people used to use little shells as money. People have used gold. People have used banknotes. Anything, as long as the person that you want to buy a good or service from recognizes that the thing that you hold has some value, it can in theory be money. The money, I think a lot of the time people were thinking of, though, is probably currency. So that's physical forms of money. coins, notes, or if in a sort of more archaic economy, that might have been other forms of, like, prior to fiat money, which is something I'll talk about in a sense. So people traded lumps of silver or a variety of other things, right? Currency, though, is the physical form. Bank money refers to the balance that's held in the accounts of commercial banks. So that's the digital money, so to speak, right? That's the numbers on your screen. It's this giant interconnected system of global finance that basically keeps track of how much money, how much value each person, each institution, each business, etc. owns. And the sum then of all of the currency, so that's all the physical money that's floating around the economy, and all of the bank money. So if you add up all of the numbers, and that includes the debts in some sense as well, but predominantly we're talking about the money that's available for trade. If you add all that up, you get what's known as the money supply. So that's the supply of available money in the economy. So then it's briefly worth considering, why do we need money? Why did we invent this in the first place? And the reason is, and I think this is probably the theory that underpins almost all of economics, which is the notion of comparative advantage. So it's the idea that we're not all, and us here means individuals, but it can also mean countries, businesses, parts of a country. All of them will have something that they're good at or something that they're better at than other people. So once upon a time, we all would have just lived on farms, and we would have grown food, and we would have used that food to feed ourselves, and that would be fine. But then over time, someone was like, well, what if I specialize in growing cows and you do grain? And then later on, someone else was like, I'll make things out of wood and make tools and etc. And the point was, now that you had a specialization of labor, it meant that people were able to output more stuff. But then you have a problem, which is, how do you exchange things in an efficient way? So originally there would have been, bartering, which is just, I give you some of my meat, you give me some shoes, something like that. But the problem with that was always, it was insensitive to changes in supply and demand. So if I was the local shoemaker, I'd have to, if I wanted to eat that month, I would have to really hope that someone in close range to me was willing to buy a pair of shoes at that time. And if no one wanted any new shoes, I would probably starve. So bartering, not very good, becomes less and less good as the economy diversifies. So money is essentially, returning to that definition of keeping some sort of store of value, is a way of buffering the delay between different forms of production and ensuring some sort of synchronized transactional mechanism in an economy, so that I can sell my shoes now, keep the money, and I can spend that money, and I know that it will be useful to me in the future. It doesn't go off, it doesn't rot. It's usually something small and easy to carry around. So originally, the concept, which is that money has to retain some value, was enforced more rigidly. So banks would, who became these big institutions that would hold people's money, because originally people didn't really want to hoard stacks of gold coins underneath their bed because someone could come and steal it, so they'd go and deposit it in the bank and things like that. Most of the time, or through most of human history really though, the money that was used had to have some actual value, or at least some type of scarcity. So I said earlier that they used little shells in some countries, like Pacific Islands, for example, because these shells were incredibly rare. And it meant that there would be a relatively stable amount of them. And because they were rare, it was impossible for people to just like go and dig up a bunch more of them and suddenly be richer than everyone else or whatever. But also things like gold that were seen to be valuable because of they were useful for creating jewelry or other high cost goods. Things like that were originally used as money. And the central bank originally of the nation would hold the nation's reserve. So this would mean that all of the money that was being used, the paper notes, were backed by something of actual physical value, which was basically a giant vault full of gold or silver or a variety of other things. So, for example, the British pound originally referred to a pound of gold. If you owned a paper note, you could in theory go to Bank of England and say, I would like to withdraw my pound of gold, and they would give it to you. Although most people prefer to carry around pieces of paper rather than, giant lorries full of gold or whatever, right? It was incredibly inefficient for a number of reasons. And I'm not going to go into them too much, but I mean, intuitively, you might be able to see that if the amount of money available in the economy is limited by the availability of gold, that has some pretty big problems, but it also created all sorts of weird perverse incentives where like countries would try and hoard gold from other countries, or if some expedition suddenly dug up a bunch of gold, suddenly they would be able to spend loads of money that they created essentially, and it caused all sorts of problems. So over time, almost all major economies, I did look it up. I think like Switzerland still has like a bit of gold, but it's like just mainly for posterity. Basically, all countries now operate on fiat money. So that means that the money is not backed by anything of physical value. It's backed by the promise of the government that issues that money, that that money will have some value. So when the US government issues a dollar, the dollar is essentially a promise from the US government that that dollar will be valuable for some purpose at some point, right? And the central banks are the ones that are allowed to print that money. Historically, they were allowed to print money. They still do, but now they largely control monetary supply through other mechanisms. But now that banks were not constrained by the accessibility of gold or whatever else it is that they used as the reserve quantity for their currency, they could start playing around with it now. They realized that they weren't fixed by the amount of gold for how much money they could have in the economy. You could increase the amount of money in the economy. You could decrease the amount of money in the economy. And this would have big ramifications in terms of the ability of governments to control the economy and to respond to shocks. I'm going to quickly pause here. Does anyone have any questions about anything I've said so far? Yeah, cool. All right. So why is the money supply something of interest? Why would the central banks want to play around with the money supply? So as I said, money is only an accounting device, right? It's like a way of keeping track of value within the economy. And that means that the price levels, i.e. how much something costs me. So you might think of this as like, how much labor do I have to produce in order to get a loaf of bread, or how many bananas is a barrel of oil worth? These questions are questions of price levels. They talk about the relative cost of different things in relation to one another. And the price levels in an economy with respect to money are literally the ratio of the money supply to the supply of the goods and the services. So if this isn't immediately obvious to you as to how this works, think about it this way. If I was to take the current economy of the country that you live in, probably not right now, it's completely broken right now due to coronavirus, but under normal circumstances, a certain amount of each good would be produced. Each service, the people providing that service, whether it's haircuts or healthcare or whatever, they can only provide a finite amount of it, right? So there's a general supply of goods and services throughout the economy, and the money is a way of taking account of that, right? So if I double the amount of money in the economy, maybe I just print a load of money and start handing out to people, the same amount of money is chasing the exact same amount, double the amount of money is chasing the same amount of goods. Hello? All right, don't know what that was. So if double the amount of money is chasing the same amount of goods, the consequence is that you start to get, you see an increased demand. People have more money, they can buy more stuff. If people are trying to buy more stuff and the amount is finite, you respond to an increase in demand by raising your prices. So you might imagine if you're a restaurant and suddenly tons more people are coming in every night ordering dinner, and you're totally booked out, you start thinking, and there's a line out the door and you go, okay, well, I guess we increase prices. Or if you're a supermarket and suddenly your goods are flying off the shelf, you go, okay, well, we raise prices, we can make more money here. Or alternatively, we don't want to run out. We want to make sure that we don't have a shortage of these goods, so we raise the price levels. So as a consequence, if you increase the money supply without changing the underlying provision of the goods and services, the price levels have to rise to respond to that. This is inflation. So that whenever you hear the word inflation, that's what it means. It means prices are going up. Cool. On the other hand, though, if the supply of money drops, so one way this might happen is just say there's a big panic and people didn't trust banks and they all took their money out of the banks and they just kept it in a stack under their beds. Well, now if there's less money in the exact same mechanism, markets will respond by lowering prices. So if no one's buying anything because they put the money under the bed instead of spending it, then you maybe drop your prices if you're a business or if you're a hairdresser or whatever, and then you drop your prices, and the idea that this lower prices will incentivize people to spend, and this means that the price is going down. This is deflation. We'll talk about deflation again in a second. So price instability is the problem that central banks and monetary policy was kind of invented to solve, because generally price stability, i.e. you want the price of things to be roughly constant, is a very good thing for an economy to have, right? Because if I know that the amount I make is enough to cover the goods, pay my rent, all that stuff, then I can plan into the future. If I know that my wage is going to be worth this much in relation to the things I need for the next couple of years, that means I can make decisions like, do I want to save and invest in a business? Do I want to take out a mortgage? Can I afford a holiday this year? Generally, or if I'm a business and I want to expand and save money and open a new facility next year, that means I need to know that, for example, the price of land is going to be relatively constant. Or if it's not going to be constant, I want it to at least be increasing at a constant rate so that I can make predictions about it. So it's very good in the economy to have stable price levels. So I've tried to sprinkle in a bunch of exercises here, so that gives you guys a chance to think about some of the stuff that's come up. So I've got 2 exercises here, which if you've studied economics, these will be pretty trivially easy. And if you haven't, it would be a good exercise, or if you already know the answer because you've already read an economics textbook, maybe don't chime in initially. But for the rest of you, read these 2 questions and try and have a little think about them. So the first one is, why is hyperinflation, so this is a period where inflation is very high, prices are rising very quickly, why is that damaging to an economy? And on the other side, why is deflation, why is prices going down so damaging to an economy? So I'll give you guys a minute to think about that. And then I'm going to ask someone, hopefully, to unmute and try and give me an answer. All right, does anyone want to hazard a guess as to why hyperinflation is damaging to an economy? Just unmute yourself and give us an explanation.
Yeah, I think that it's because people generally receive a paycheck and have a certain amount of money in their bank accounts, and suddenly if their prices go up very, very quickly, that means that they can't buy stuff on the daily basis. Suddenly they can buy like half of what they could have bought yesterday.
Yeah. So one, it means people just simply might not be able to afford stuff because the price is going up quicker than wages. That is obviously pretty undesirable. Also, it means that if people know that they're in a period of hyperinflation, it means you get your wages and you go and immediately buy everything you can because you know that it's going to be 3 times as expensive tomorrow. So then that leads people to hoard. It also, for the reasons I outlined earlier, it makes it really hard for people to plan anything, right? For a business, it's like, if your profit projections for the year and rely on, having sold a certain amount of things and those things be, that the money that you collected for them being worth something, if you sell all your inventory for, say, €1 million, and then next week €1 million is worth what 1,000 euros was before, you've basically just given away all your stuff. So just the entire economy grinds to a halt pretty quickly. And also it tends to be a bit cyclical. So once hyperinflation starts, governments end up in a situation where no one can afford anything. So they need to print more money just to pay for their workers and things like that. And then that leads to more inflation, and it creates a vicious cycle that's hard to escape from. Does anyone want to try and explain why deflation, not even hyper-deflation, that would be bad for similar reasons, right? Why is any amount of deflation potentially really bad? So prices are falling. So what that means is the money that you have is becoming more valuable. The money that you own over time is allowing you to buy more and more things. Why would that be really bad for an economy? Just unmute yourself if you have any idea.
So maybe it's that everyone also businesses are always know that they can make more money if they wait to make an investment later rather than doing it right now. And so everyone puts off, all of the businesses put off making new investments, and no one gets hired or anything.
Yeah, so it can have bad consequences for businesses, but think of what you just said, and now apply that to individuals. What might that do? How might that change individuals' decision making?
Yeah, people are also want to like save their money as long as possible because they know they can get whatever they want to buy cheaper if they get it tomorrow. So they put off, like, I don't know, renovating their house or something, or going on vacation, doing anything that would stimulate the economy.
Yeah. So if I know that prices are falling, why would I buy a car now? Why not wait a week and my car's going to be 5% cheaper? And this applies cyclically, right? It's the same thing. If now what happens if no one's buying anything because they're waiting for things to get cheaper? Well, businesses need to try and attract people. They need to try and convince people to start spending again. So they will drop their prices, which is the definition of deflation. And the more businesses are dropping their prices to try and encourage people to buy stuff, the more deflation is happening. It's called a deflationary spiral. It's every central banker's worst fear. It's actually considered to be more damaging than hyperinflation. There's ways out of hyperinflation that are relatively well understood. Once deflation kicks in, it's really hard to correct it, because once people have the idea that things are going to get cheaper in the future, they stop spending. That causes a recession. The recession causes more deflation. Now people don't want to spend because of the recession. It's a cyclical problem. It's pretty. Whenever it's happened in history, it's been catastrophic. So yeah, as I said, hyperinflation wipes out people's savings, invalidates investments, causes people to panic buy, and it's a cyclical process. Deflation incentivizes saving, decreases money supply, further deflation, causes a recession or even a depression, which is where you have a prolonged contraction in economic output. So the economy shrinks and it doesn't recover, it just shrinks and stays lower. Okay, so both of those things were bad. So central bankers and economists started studying the money supply and started studying the flows of money in the economy and tried to understand, what was causing inflation, what was causing deflation. So yeah, I'm just moving stuff around my screen. So this graph is really interesting because it starts from the 1600s, where monetary policy wasn't a thing. I'm not even sure if the Federal Reserve existed then. Money existed in its current form. It probably existed in some capacity. They were on the gold standard, and you can see the economy is constantly rocketing back and forth between big spikes in inflation, big spikes in deflation, big spikes in inflation, big spikes in deflation. You might imagine that being a businessman or trying to invest or really do anything in this period would have been an absolute nightmare. And consequently, the economy in this period grew relatively slowly. Then what happens? We get into I don't know the exact date. I probably should look this up. But at some point, they got off the gold standard. So the gold standard was causing a lot of these swings, because if you have a fixed money supply, change in demand or change in supply, so if people start producing more goods and you have a fixed money supply, that causes deflation. Or if there's a drop in production and a fixed money supply, that causes inflation. So at some point, I'm not entirely sure where on this graph, but they got off the gold standard and that started to stabilize. I think maybe it was in the 1900s. I'm reasonably sure it was around the First World War. So then they get off the. So you can also see here that there's a big spike after 1900. That's the Great Depression, I think, or maybe it's the negative one. Point is, around the 1980s, I think that's when economists really got a grasp on how monetary policy worked, how monetary theory worked, and since then you can see we've been in a period of relatively low but stable inflation. So that is the goal of monetary policy. We're trying to control price levels. We're trying to keep inflation and deflation under control. So how does this work? So most central banks have a mandate, which is for inflation targeting. So the government has basically said to them, and it's important to note here, I don't know if I put it in, but I have there. Central banks are independent. This is a relatively recent phenomenon. For example, the Bank of England was only made independent, I believe, in 2002. And historically, they were kind of a branch of the government, and that meant that the elected government was directly in control of monetary policy. This was a really bad idea, because it's fine if you can trust the government to act in the interest of the people in the economy, but a lot of the time they don't do that. And what they would often do is they would use monetary policy in ways that would increase their chances of being re-elected. So they would basically try and make loans really cheap in the run-up to an election, so that people's mortgages were cheaper to service, or businesses could borrow more money and hire more people, and they would create artificial economic booms in the short run in order to get re-elected, and then inflation would kick in afterwards, and they'd be like, well, that's a problem for later. And this was obviously really bad. So nowadays, central banks are almost without exception independent. So that means there is a body of economists who are separate to the government. Usually the head of the central bank will be appointed by the government, but they're appointed for their expertise. The government only does one thing really in terms of central banks, which is they tell them, try and keep inflation at around 2%. So we'll, handle spending, the economy will go up and down. Your job is to keep inflation at 2%. So, question, anyone want to guess? Why 2%? Why not 0%? Surely it'd be better if prices were just completely flat. Wouldn't that be a lot easier? Why anyone want to guess why they said 2%? Well, that's an easier question. Why did they set a positive target of inflation and not 0? No? Okay, so there's a couple of reasons. One, it gives you breathing room to avoid deflation. So if you look at this chart on the right here, it's a bit confusing because the red line is not 0, the red line is the 2% target. This line here is slightly lower down, is the 0% line, so that's 0% inflation. And you can see that the inflation is not really sticking at the target, it's spiking all over the place. So we see here a huge spike in 2008. That was the global financial crisis, so a huge spike in inflation. Then we start seeing a period of deflation. We'll talk about how they get out of that in a second. Then we have a period of heightened inflation. This was caused by, I believe, the 2011 Euro crisis. And then inflation starts to go down and it starts to get to 0. But the point I want to make here is inflation targeting is really hard. The things that central banks do take a long time to translate into the economy. Up to 6 months from any change in policy. And that means you have to make predictions upon the future, but lots of things can, outside events, things like coronavirus can kick in, or big recession, or suddenly your neighbor starts war with you or whatever, right? The point is it's always going to dip up and down. If you're at 2%, it means a dip takes you down to 1%, something like that, right? If you are targeting 0 and you're fluctuating around 0, that means you can dip into deflation quite often. So you can see here in the UK inflation chart, in 2015, they dropped all the way down to 0. Imagine if they'd been targeting 0, that the pressures that caused that drop to occur, largely driven by austerity, those would have pushed it down to -2%. Then you would be in deflation. Now you would be in a potential crisis. It also keeps unemployment low. I think I'm going to talk about that in a second. It also ensures that the money supply is constantly growing. So it means more money is appearing constantly. This grows roughly in line with the economy growing. So as the economy grows, i.e. people are producing more stuff, there's more money available to purchase for it. It means that it tries to keep a close match between the two quantities. All right. So how do central banks make these decisions? How do they, what are the things that they watch? There's a variety of things, one of them obviously being inflation. But another thing that's really important to central banks is employment. Now, you might be thinking it's a weird connection, right? Why would employment and inflation, why would they be linked? So let me tell you, firstly, that we'll come to the realities of this in a second. But on a theoretical level, low employment causes inflation. So again, I'm going to give you a minute. Can anyone come up with a basic argument why lower employment? So, sorry, that should be low unemployment. Apologies for that. I'll edit it in a second. Why does low unemployment, so lots of people being employed, cause inflation? I'll give you a minute to think.
Nie oszczędzają, bo myślą, że...
Well, I think that's because people generally have more money. So people who are the suppliers think that they can raise the prices. I think that's raise the prices. Sorry, and still earn money. So just they do it because it's profitable for them.
You're close, and that's a very good explanation. The one, I guess, problem with it is if a business can raise their prices and people will purchase it, they always will. There's never a situation in which a business could raise price. I don't know. Maybe sometimes they do it for ethics. I don't really believe that that's common, right? If a business can make more money, they will. If they raise prices and their competitors don't, people will shop with their competitors instead. And so generally, they won't raise prices unless they absolutely have to. Or they change the product in a way they think makes it more valuable. So, but you're pretty close. So let's examine the answer. The first one is, as you correctly identified, more employment means more income. More people are earning money, more people have money to spend. More income, more spending. Yep, already said that. More spending means that the supply is reduced, because if people are buying up the existing things that are being made, that means there's less of the things to buy. That's the definition of supply in an economy. And for businesses now want to respond to this, obviously, by increasing their supply. But generally, to produce more of something, so say you're making cars, right? Suddenly people are buying more of your cars. You need to make more cars. How do you do that? Well, it's not like usually there isn't like a dial in the factory that you just turn up the dial and more cars come out. Because if that was the thing, you would already be doing it. Generally, you need more people. But if you need to hire more people and the labor supply is low, but like by definition, because we're talking about low unemployment, then how do you hire more people? Well, you raise the salaries that you're offering. You raise the wages. You offer people more money to try and tempt them away from wherever it is that they're working now, or maybe tempt people to come out of retirement or whatever else it is that currently. Sometimes people just stop working because they can't be bothered. They already have enough money or whatever. The point is, you raise salaries to try and get people back in. If you're raising salaries, that means your costs are going up, and so to maintain profits, you raise prices. Now, the point is that because everyone is affected by this symmetrically, so all of the car manufacturers are simultaneously trying to produce more cars, that means all of them can raise their prices and they're not losing out to one another. Now, this is called the Phillips curve. So it's the relationship between inflation and unemployment. Now, this is a really good thought experiment, and it's really worth thinking about because it kind of links some of the more understandable aspects of how economies work to concepts like inflation. But I will add a caveat here, which is that while historically the Phillips curve was a very useful tool and was considered very closely by central banks, it doesn't seem to work anymore. So in recent decades, particularly since the financial crisis, if you make a plot, like a chart of inflation versus unemployment, almost no connection. Now, this is not because what we've just said there is untrue. It's just that the global economy now is so sophisticated and people aren't just competing with one another. So one thing, for example, is now you don't necessarily have to offer higher wages to get more labor. You just get more immigrants from another country. Things like that have basically made the globalization of the economy has largely caused price levels to stabilize. And so this Phillips curve thing isn't working as well as it used to. But it's a useful thought experiment to understand some aspects of how monetary policy interacts with the real economy. All right. So as I've said, let me recap quickly. The goal of central banks is to control the monetary supply in order to keep price levels stable. Does anyone have any questions at this point? Does anyone want to add anything? Anyone want to say anything? Now would be a good time. The more interactive this is, the better, but I also understand that sometimes people just want to sit and listen. All right, let's press on. So there are a number of different tools available to central banks for controlling, I should say the monetary supply, but inflation, deflation, etc. These are known as policy instruments. So I've put a list of them out here and we're about to go through them all. The main thing to note is that we can classify the central bank's policy, i.e. the way in which they're deploying these tools, as expansionary or contractionary. So expansionary means that their goal is to increase the monetary supply. If they increase the monetary supply, means they are trying to get inflation, or trying to increase inflation. So if you're below your target, if the economy is currently at like 0.5% inflation, you want to get inflation up, you increase the monetary supply. If you want to decrease the monetary supply because inflation is too high, contractionary monetary policy. Oh, the last thing I wanted to say, sorry, about the Phillips curve here, is that the Phillips curve works both ways. So also having higher inflation also tends to mean that employment goes down, because if inflation means rising prices, which means businesses are getting more money. It means if they know that if they hire someone now at a certain salary, that person's salary in real value terms is going to go down over time, which is the inverse of what happens under deflation. So generally, a small amount of inflation also makes it attractive for businesses to hire more people. Cool. Yeah, so it's expansionary and contractionary monetary policy, depending on what they're trying to accomplish. So the simplest tool of monetary policy is currency issuance. So quite literally printing money, or pulling money out. So going and collecting banknotes from banks and burning them or putting them in a box or whatever. So you're quite literally just changing. It should say you're changing the amount of currency, right? Obviously, that affects the money supply because currency is a component of the money supply, but it's limited only to increasing the number of banknotes or coins, or whatever. It's not really something that central banks use, contrary to the memes that you might have seen about the money printer, because it's not very efficient. You print a load of money, and now what do? You've got to load it up into lorries and send it all around the country and give it to banks, and then they've got to hand it out to people. It's just not a very good way to do monetary policy. Most of the time when central banks are engaging in currency manipulation, they're actually just responding to economic growth. So if the economy grows, that means more people are trading. And if more people are trading, there's a need for more currency, more people are pulling money out of the bank, more businesses are exchanging notes, etc. So they'll generally print more money, but just to meet the boundaries of economic growth. The tool that you may have heard about, and probably the one that's, I think, yeah, I mean, this is the one that most people pay the most attention to, because I think for the average person, this is the one that most directly influences their life. And this is the so-called interest rate. So you may have heard, or you open up the BBC and it says like the Bank of England has voted to reduce interest rates, or the Federal Reserve has increased its interest rates, or the European Central Bank has decreased its interest rates. In my lifetime, the European Central Bank has never increased them. We'll talk about that in a minute. So what is the interest rate? Interest means the extra return on a loan. So it's the amount of money extra you get if you lend someone money, or conversely, it's the amount you have to pay back extra if you borrow money. So if the interest rate is 2% and I borrow $100, that means I, at the agreed date, have to pay back $102. Now, I was going to go into detail here, but I realized it's never going to come up in debates. So central banks have a huge number of different ways of manipulating the interest rate. So generally, when you hear, or when you open up the news and it says interest rate has been changed to this, what that means is it's target. So they're targeting. So if the rate is said to be 0.5%, it means that they're targeting that the average level of borrowing in the economy is going to be about 0.5%. And this also affects, through other mechanisms, the return on the interest for commercial banks. So you may know that if you put your money in the bank, you once a year or whatever will get a letter that says you received, lately it's been really low, like you've received, I don't know, 0.2% interest on your deposit, and they'll give you like 50p or whatever your currency is, right? Like it's nothing. And the reason is that since 2008, due to the global financial crisis, interest rates for central banks have been very, very low. And what that means, therefore, is that the return on the interest for saving is low, but also that the cost of borrowing has been low. So things like mortgages have been very cheap, things like car loans have been very cheap, credit card debt has been cheaper, businesses have been able to borrow more money. Lots of businesses have borrowed lots of money. It's creating lots of problems now that we're in a new recession, because all these businesses have borrowed lots. Because even if money is cheap, right? Even if you can borrow money very cheaply, you still need to invest it in a way that you get that money back. So lots of businesses have borrowed lots of money at very cheap rates, but their businesses have not really benefited from using that money. And so now they're in a situation where they have large debts, and even though those debts have very small interest on them, they still can't pay them back. So the general trend is when interest rates are high, the cost of borrowing is high and the return on savings high. A high interest rate, something like 10%, would mean that if you put your money in the bank, generally you'll get somewhere near 10% of that a year as interest, which is obviously a lot, and that would make it would give you a big incentive to put your money in the bank. but it would also make it very expensive to get a loan. So if you wanted to get a mortgage, for example, the cost of borrowing that money would now be like 10% a year. So it would not be in your interest to get a mortgage. Well, it wouldn't be in your interest, but mortgage would be very expensive at that point, or a car loan or whatever. Conversely, when interest rates are low, the cost of borrowing is low and the return on savings is low. So when interest rates drop, that means people who are on mortgages that are linked to the bank's interest rate, their payments go down each month. So this is why people in the news like to pay attention to the interest rates, because if you have a mortgage and it's linked to your bank's interest rate, if the central bank cuts its interest rates from, say, 3% to 1%, although it's not in a perfect transmission, but roughly speaking, the cost of your mortgage payments is going to go down by up to a third. It's going to go reduce down to approximately a third. It's not perfect because banks will make use of some of that discrepancy to make money. But generally, if interest rates go down, your car loan gets cheaper, your credit card loans get cheaper. You might be able to refinance debt that you already had. So maybe you borrowed originally at 5% interest, and now interest rates go down to 1%. So you take a new loan at 1% and use that to pay off the 5% loan. So generally, that's the relationship. Can anyone see at this point, this is the question, can anyone see how this relates to money supply and inflation and stuff like that? Anyone want to explain what the connection might be between the availability of loans and the money supply?
I mean, the availability of loans is kind of like there being more money in the economy. If I can access money more readily, that's kind of very similar to there just being more money out there. And so I guess lower interest rates would be more likely to cause inflation and higher interest rates likely to cause deflation.
Perfect. Yeah. Cheaper loans, more people borrow money, more people spending money. It's the same thing functionally the same thing as if I'd printed money. The key difference, though, this is worth bearing in mind when we talk about the other policy instruments, is that if I print money, the money goes in, nothing comes out. If a bank issues a loan, though, yes, more money goes into the economy, but that money gets paid back later. So the net balance in the money supply on the long run is neutral. That's why it's different to printing money. That's why lowering interest rates, while it causes inflation, doesn't tend to cause hyperinflation, because financial institutions, banks, central banks, investment funds, whatever, they know that all debts have to be repaid. And so in their accounting, they'll keep track of how much money is owed versus how much money has been lent out, and that keeps things stable. So while it does, in the short run, increase inflation, it's not like free money, although you often hear it talked about in the news as if it is. So interest rates. So as I said, this is the main tool that central banks use in order to guide the economy. They will respond to economic changes by changing the interest rate. So over here, we can see a chart going back to 1980. And back then, interest rates were very high, peaking at around 20% sometimes. And over time, each time there's a recession, so when a recession happens, that means people are spending less. So the governments want, or businesses, for example, see a decrease in people buying their stuff. Generally, the risk of borrowing increases. So in the middle of a recession, if you run a restaurant, you know that people are going to be, for up to a year, 2 years, whatever, not going to be coming to your restaurant as much. So maybe you take a loan in order to keep your business going during the period of lower demand, and then you pay back the loan once the economy recovers and people start coming back to your restaurant. Apply this to any other business, right? So therefore, it's in the interest of the central bank during a recession to drop the interest rate so that people borrow more money and people start taking out mortgages, or they get loans on cars, or the businesses borrow money and use it to expand, stuff like that. And that kind of reinflates the economy, right? Then the idea is that once the economy starts growing again, you want to cut off that supply, because in some sense, what they're doing when they lower the interest rates is that they are encouraging people to take on debt, but not all loans are used in a productive way. So if I borrow to buy a giant mansion in I don't know, Oklahoma or somewhere, as a lot of Americans did apparently, then that's fine as long as I am earning enough money to pay back my mortgage. But if I lose my job and default, then suddenly the bank, that loan has become worthless to them. Instead, they have a house, which maybe no one wanted your hideous McMansion in the Midwest of the USA. It's basically how the global financial crisis happened, because too much lending was happening without enough due diligence as to the quality of those loans. Now, you'll notice the phenomena is interest rates go down. That's central bank's response to a recession. And then they gradually go back up. Then they go down. But the general trend has been down, 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 down until we've hit about 0%. And there's a lot of reasons why this is the case, but basically we're in a precarious situation for the global economy. So low interest rates, around 0%, means that there's basically no point keeping your money in the bank. You should be spending it, or you should be trying to find more productive uses for it. So the idea is that people should be buying stocks or buying government bonds or just buying stuff. The problem is that since 2008, it was such a severe financial crisis that basically people have been too scared to buy anything. Businesses are scared to expand because they're worried that the next recession, and probably, I guess they were right, coronavirus has absolutely tanked the global economy. But that's why they weren't able to raise interest rates, because the economy, inflation wasn't returning, the economy wasn't growing, people weren't spending enough. This is why interest rates, for example, in the USA, but also in the Eurozone, also in Japan, also in the UK, also basically every country in the world has had significantly lower interest rates than the historical average. Cool. Yeah. So one thing to note there is that this has been a huge cause for concern, because it's kind of a tool, which is in a recession, you drop your interest rates to encourage borrowing. But if your interest rates are already at 0, you can't encourage people to borrow without dropping your interest rates. Negative interest rates are a thing, but that creates really weird incentives where like the bank charges you money for storing, for depositing with them. So people are like, well, why would I put my money in the bank at all then? Why not just like keep it in my house? The risk of, roaming barbarians coming and stealing your gold coins isn't really a thing anymore. So the risk of going negative is that people just stop putting money in banks, and that has all sorts of other repercussions. So we're in a bit of a precarious situation. So then what else do they do? What are the other tools that they have? I'm going to talk about market operations in a second, but before that, we're going to need an explanation. Maybe you've heard the term liquidity. So what is liquidity? It's the ease of using an asset as money. It's a very obtuse sentence, but what it means is if I need to buy stuff, how good is this thing for buying stuff? So money, currency or bank money, the money in your bank account or literal notes, is obviously the most liquid asset because it is literally money already, and you could just always use it for commerce, for trade, right? I'll never be in a situation unless the economy tanks completely, where I can't go to the supermarket and exchange money for goods. Other assets, though, are less liquid, but can still be considered as relatively liquid. So if I go with a bar of gold to Sainsbury's and whatever your local supermarket is and try and buy food, probably not. But I will be able to find a buyer for gold and silver very easily. Other things like high demand stocks, so I own stocks in like Amazon or Apple, there's never going to be a situation where I can't find a buyer to purchase those things. So those are, while not fully liquid assets, they're not literally money, they're still very liquid. There's never going to be a situation where I can't easily convert them into things that I need, into things that I can buy stuff with. Other assets are moderately liquid. So you can usually find a buyer, but that buyer, if you're in a rush to sell a lot of it at once, may not be willing to pay as much as you want for it. So for example, if I own a large amount of government debt and I try and sell a lot of it quickly, people will start wondering why I'm trying to sell so much government debt quickly, and they maybe will start offering me less and less money for it. So that's one issue. It's also worth noting here that liquidity applies when considering the wealth of wealthy individuals. So you'll often hear like Jeff Bezos is worth $100 billion US, whatever, right? This doesn't mean he literally has like a vault in his house filled with stacks and stacks of dollars worth $100 billion. It means that his total assets are worth $100 billion. The problem is most of those assets are not very liquid. So most of his wealth is stored in shares of Amazon, and maybe he could sell, maybe he could sell like 1 billion of those without raising too many eyebrows. But if someone was like, Jeff Bezos, you have to give us all your money tomorrow, and he just tried to dump 100 billion, or not 100, I think he has like $70 billion worth of Amazon stocks on the stock market at once, the cost of those stocks would go to zero. Everyone would be like, what the hell's going on? Why is Amazon's owner trying to sell their stocks? What does he know that we don't, etc. So liquidity not just relates to how easy it is to convert, but it's also how much that thing will retain its value when I try and sell a lot of it. There's other assets that are considered illiquid, i.e. the conversion process between them and money is almost not impossible, but just very difficult. So like real estate is a really good example of this. If your bank, if everything they own is collateral, is people's houses that they've just defaulted. Selling all those houses at anything other than a huge loss for what they were originally worth is going to be impossible. Another one is collectibles such as art. So a lot of rich people have like large amounts of their wealth stored as art collections, which is fine, but selling art is really slow. Big art auctions for like rare pieces will only happen a couple of times a year. So those are considered illiquid assets. So what's the relevance of this? We need to talk about a specific type of government of asset, which is government bonds. So if you're not already aware, almost all governments spend more than they collect in taxes. So this map on the right shows you the European Union and the UK and Russia, I guess, probably some other countries. And the number is how much more or how much less they spend than how much they collect in taxes. So you can see Norway, for example, is collecting a lot more in tax than they are in spending. This is due to their oil. They basically, all that extra money goes into their sovereign wealth fund. They basically have a big account worth trillions of euros at this point, I think, or krona, I guess it's their currency, which they're going to, when the economy slows down in the future or when they run out of oil or whatever, they're going to spend it then. Other countries, you can see like France, for example, running a big deficit. So they spend 3% of their GDP more than they collect in taxes. So how do they meet this gap? They do it through the sale of what are called bonds. So this is, the government basically says, we want to borrow some amount of money, and they'll basically go to private actors. So that can be banks or it can be private investors. Anyone, you or me could log onto the website and basically say, I'm happy to buy £1,000 or €1,000 worth of government bonds. And it's essentially a promise that the government will repay you that money in the future plus some interest. So the yield, as it's known, the yield on a government bond is how much more money you'll get in the future for lending the government money. And it's considered a safe asset because generally, governments tend to not fail. Historically, they fail very rarely. And so if you lend the government money, you can be pretty damn sure you'll get it back. Very, very rarely do governments. Jesus Christ, biggest moth I've ever seen just flew into my room. Okay, so so it's considered a safe asset, and that also means that when banks want to have capital on hand, so generally regulations require banks to have some sort of assets that are, going to store their value as reserves, basically. Government bonds are an acceptable capital requirement because you can trust that if you have £1,000 worth of government debt, it's worth £1,000. There's never going to be a situation where the government pays you back less than £1,000. You'll always get that money back. So this is a form of relatively illiquid asset because most of the time people would rather hold would rather hold government bonds because they're a safe store of value. But people are generally willing to buy them too because they know they're quite safe. So the next tool that central banks have is called market operations, and these predominantly relate to controlling liquidity in the markets. So if, for example, you suddenly have a financial crisis or something and tons of people are trying to pull their money out of the bank, or banks are trying to move money between one another, trying to swap things, trying to respond to market changes or whatever, if they don't have enough money on hand, then you run into what's known as a financial crisis, so the run on the bank is the easiest way to understand this. If you went to the bank and tried to pull out money, the bank doesn't actually have if you have €1,000 in your bank account, the bank doesn't have €1,000 sitting on a shelf. They have maybe, 8% of that actually kept in safe assets. The rest is already issued out into loans to people. So then the concern is that if a load of people try to withdraw their money, very quickly the bank actually runs out of money that they have. So then what they do instead is they'll turn to the central bank and say, we need money, we need to meet our obligations. We don't have money right now. What we have is government bonds, and so the central bank will say, okay, well, we'll take your government bonds, we'll hold them for 24 hours usually, sometimes like a week. Afterwards, you'll buy them back off us at a higher rate, so we get profit from it. But in the meantime, this will give you some money so that you can meet your obligations in the short run. And in that week, maybe you can sell off some other stuff that you've got to the private market, sell off some mortgages, sell off some loans in businesses, whatever, in order to get that money so that you can resume lending normally. So this is what market operations means. You may have heard of repo. So during the peak of the sort of coronavirus market crash, there was lots of bullshit articles going around on Facebook saying, oh, the US government just, injected $1 trillion into the stock market. This is not what happened at all. What happened was the Federal Reserve, the central bank of the USA, expanded its repurchase operations, and basically said it would buy a much larger, hold on, the sun is streaming to my room at the exact wrong angle. It would basically buy a larger amount or more risky assets from these, from banks, from financial institutions, so that they could get money in the short run, because they didn't have enough money and lots of people trying to sell stuff at the same time due to the stock market crash. The other one is foreign exchange swaps. This is where banks basically swap foreign currency, but we're going to talk about that in the second lecture. All right, quantitative easing. Probably everyone's heard of the term in quantitative easing. Does anyone, I don't know, I'm not going to ask a question here, I have questions on the next slide, but quantitative easing is a new thing. It's relatively new. I mean, in the Eurozone, it started after 2008. Japan's been doing it since 2002. The UK and the USA also started in 2008. It's basically, so going back a second, I said here that central banks normally use interest rates to respond to economic pressures, and interest rates have been stuck basically at zero. So during this period, really those interest rates should have been much lower, but they couldn't do that for the reasons I discussed. So they needed new ways of conducting monetary policy. They needed new tools to try and prop up the economy, to try and boost inflation, boost demand. So they came up with this thing called quantitative easing. So what that is the problem is that interest rates are basically stuck at zero, because no amount of cheap debt will, oh my God, I guess it doesn't really matter if you see me or not. No amount of cheap debt will ever convince people at that point that it's worth borrowing money. Like if you think that the economy is in a state of extreme crash, you're not going to go out and borrow money to buy a car because you're worried that you might lose your job next week. So no amount, setting interest rates at zero is not enough to convince people to borrow money. At that point, then you start entering into the risk of deflation, and you can't cut interest rates anymore, so you have to do something else. So what they decided to do is to engage in what's called quantitative easing. This is essentially a way of creating money by purchasing financial assets. I'll talk about what those are, but note that this is different to market operations I talked about on the previous slides, in the sense that for market operations, the central bank was saying to a business, we'll take your government bonds off you for 24 hours, for a week, but you have to buy them back from us after that period, right? So it was a short-term exchange, basically. We swap money for assets. What's different about quantitative easing is that they are outright buying these assets from financial institutions. They are buying them at cheaper rates than they would get on the market, or perhaps buying them when no one would buy them otherwise. And they have no fixed period into which they will return. So a bank can sell so like during the financial crisis, some of the big banks would basically sell lots of their shitty debt to the central bank, to the Federal Reserve. Or currently, for example, the European Central Bank is buying up lots of crappy debt from Italian banks, from Spanish banks, etc. And there's no requirement for these banks to ever repurchase it. The central bank can sell this stuff in the future, but they are now essentially creating money. So this is almost equivalent to printing money, in the sense that you have taken stuff out of the economy and put money into the economy. Does anyone have any questions about that? Because I don't know if this is really hard to explain, and I don't know if I'm being particularly clear. So I'd really appreciate if someone could ask me a question so I can gauge how well I've explained quantitative easing. All right, I'm going to assume then that that was a perfect explanation and everyone is on board. Or they're so confused that they have no idea what to say. If that's the case, hopefully it'll become a little bit clearer. So let's kind of think about 2008 and the global financial crisis. So maybe you've read articles about it. I mean, enough have been written by now. Maybe you've seen The Big Short. What happened was basically banks, predominantly in America, but also somewhat in the UK, and in other countries, were basically lending people money for mortgages, but without checking if these people would actually be able to repay it back in the future. So more loans for mortgages, more people were getting mortgages, more houses were being bought, more demand for houses means that house prices went up. House prices going up made it look like all these loans were like really good value, right? Because if the bank has a loan on a house and that house is worth a lot of money, even if the loan can't be repaid, they get the house back and the house is worth tons of money. So banks basically engaged in lots of like tricks to hide the amount of actual risk involved in these mortgages. They were basically lying to people and saying that, oh yeah, like all these people will definitely pay back their loans. I'm actually going to have to speed up. I realize this is, we're sort of running out of time. Okay, so basically they ended up with large amounts of loans for houses that were worth nothing compared to what the loans claimed they were worth. And all the banks were going to fail and the entire economy would have crashed. So what the quantitative easing program did then was the central bank basically just bought all of this crappy debt, took it off the hands of the banks and said, you know, we'll take care of this now. And in doing so, they unlock a lot of money that can now be spent in the economy. The other thing they do is they buy up corporate or government debt, so that they'll buy government bonds from banks, like I said earlier, again, but with an indefinite period on them. Or in extreme circumstances, this has happened for the first time in history in the UK in the last couple of weeks, the central bank will literally buy government debt directly. So rather than going to a bank and buying the bonds that the bank owns, they'll buy the debt directly from the government. This is really extreme, right? Because it means that literally what is happening is that the central bank is printing money to finance government spending. This is why it's only happened recently, because of the severe circumstances. The risks are quite substantial. So so obviously the reason they're doing this is to keep inflation up, to keep the economy, performing. So what are the problems, right? So while quantitative easing has generally a high level of support amongst central bankers and academic economists and so on, there's also an understanding that it poses a lot of risks. So one of them is that if the central bank is constantly purchasing up these debt things, whether it's government bonds or corporate debt, they're also making those things less profitable for the people who own them, right? Because it's like, why would you sell one with a very high interest when the central bank is willing to purchase it at a lower interest rate? So for pension funds, which have historically relied on having big blocks of government bonds, for example, so they get the interest on the bonds, and that provides the return for the pension fund so they can pay out pensions in the future. Quantitative easing has basically made all of these things worthless. And so as a consequence, a lot of pension funds now are really underfunded. Another thing, and this is probably the big one, is that quantitative easing appears to have massively contributed to inequality. Because if you're buying debt that otherwise is worth a lot less than you're willing to pay, that the central bank is willing to pay for it, who benefits from that? Well, it's all the people who already own lots of financial assets, people who are already wealthy. So if you had a big investment in a firm like BlackRock and suddenly the central bank has just bought billions of dollars of BlackRock's shitty debt, you now get much better return on your investment than you would have done had the economy been allowed to fail. Perhaps you might argue it should have done. The next thing is obviously because you are in effect printing money, not literally physically printing it, but you are just creating money out of thin air. There's still the risk of hyperinflation. Although people have been saying that hyperinflation is around the corner since 2008, it hasn't happened yet. So it's unclear how big of a risk this one is. Where inflation has occurred, though, is in things like house prices. Because once you buy up non-performing debt, rich people, like I said, they're not going to put it in the bank. This is interest rates at zero. So what do? Well, they go and look for other things to spend it on. And the big thing has been housing. So rich people have used all of this new unlocked credit, basically, to purchase up tons of housing, especially in major cities. You can see in the UK here, somewhere around 2009 is when the quantitative easing program, and all of a sudden house prices inflate back up again and actually go far higher than the peak that they were in the so-called bubble that led to the financial crisis. So quantitative easing has caused quite a lot of problems for in terms of inequality and in terms of things like house prices. Lastly, there's the political risks. The reason why governments only turn to using central banks to buy government debt in extreme circumstances is because there's a really slippery slope. So once the central bank starts giving the government free money, basically, and the government starts spending that free money, it's a bit of a slippery slope. It becomes very hard for the government to wind that back. because now they're sort of reliant on maybe like 10% of the government spending is coming from the central bank, and the central bank at some point has to say, nope, inflation's gone too high, we need to cut you off. And now the government is left with the option of either, raising taxes, pretty unpopular, cutting spending, even more unpopular, or like, I don't know, violating the central bank's independence, forcing them to continue spending money despite inflation, to continue printing money despite inflation. So this has been a big concern for a lot of people, is that quantitative easing may be a bit like a drug, right? Once economies start becoming dependent on central banks financing cheap loans, basically, whether for government or for businesses, everyone's just going to get hooked on these loans, and we'll never be able to return back to a system in which the cost of borrowing is somehow connected to the the actual risk involved. Okay. The last one, and this is, I think, the funniest one, just because the idea is so ridiculous that it's hard to believe that this was an actual, and it still is, a topic of discussion amongst academic monetary theorists. It's called helicopter money, and in the original lecture in which it was proposed, it was analogized by Milton Friedman to the central bank literally printing money with a printer, physical notes, and then just flying helicopters over cities and just trickling out banknotes for people to scoop up from the street, with the idea being that this was essentially a literal way of printing money and getting it directly into the hands of people. In practice, if this was ever done, it wouldn't be via a helicopter. It would be something like the central bank would print a certain amount of money and put 500 euros in everyone's bank account. Say, there you go, everyone, free 500 euros. It's not been tried, although a lot of people have floated the idea lots of times. And the reason is literally no one knows exactly what might happen if that starts. It could lead to hyperinflation. Everyone's like, oh my God, money is free now, and they just go out and try and buy as much stuff as possible before the money disappears. It could be a liquidity trap, so people just save that money. They still don't want to spend it, so they just keep it in the bank anyway. It could destroy trust in central banks. So historically, people have trusted central banks to keep price levels stable. If they start fucking around with the price levels by just printing money and handing it out to people, people may stop trusting them. It could also be exploited by populists. So once a central bank does a one-off giving everyone $1,000 by printing money, it becomes very easy for a politician to say, look, see, they can produce money out of nowhere. Put me in power. I will I'll take back control from those greedy central bankers, and I'll print more money, and we'll all be rich. And it would be very hard for central banks to say no to them, given that they've already demonstrated that it's possible. So this is a bit of a Pandora's box. Central banks, generally speaking, have tried to stay away from this. So I was going to talk about foreign exchange, but it's probably more relevant to the next lecture. So I'm going to skip over this, because the next thing I want to talk about is currency unions and the euro, which is probably, I guess, the thing that most directly relates to debates. But I mean, a lot of the other stuff I think has relevance to euro debates, but also to a lot of economic debates. Does anyone have any questions about anything that's come up so far? Any of the monetary policies, helicopter money, quantitative easing, interest rates, market operations, any of that stuff? Any questions?
I don't know if this is a stupid question, but isn't what they did in the US by giving everyone a check for like $1,200 kind of similar to helicopter money, or is it not, because it's not coming from, or was it coming, I don't know where it came from.
Yeah, so that's a really good question. That's a really good question, because one of the discussions that happened at the time was, where should the money for that come from? So that and it's a really good question, because it's like, in some sense, it seems arbitrary, right? Why does it matter? The reason is that it was carried out as a form of fiscal policy. So the government issued debt and then gave that debt to people. That means that the government will be on the hook for repaying it in the future. It wasn't financed by the central bank, because that would have meant that the central bank would create money out of thin air, and then it wouldn't necessarily have to be repaid back. It's important to note that in theory, all of the loans that via quantitative easing that central banks have created are sitting in a balance sheet. They have a very detailed register of everything they've ever bought, right? In theory, at some point in the future, they could start trying to sell some of this stuff off. No one really believes that's likely to happen, but they always have the possibility. So if, for example, the money supply gets too big and inflation increases, central banks can one day start selling off these assets and pulling money out of circulation. But yeah, so with respect to the check in the USA, that was fiscal policy. It was financed from taxes and borrowing, not by the central bank. But it's a good question. there's a question. At some point, though, the lines start to get blurred, right? Because, like in the UK, as we've recently seen, the central bank is lending the government money, and then the government is giving that money to people via the furlough scheme. So a lot of people are sort of asking, aren't we already doing helicopter money? If the central bank is giving the government money and then the government gives people that money, wouldn't it make more sense to just have the central bank give people money? We're in strange times for economics. Okay, currency unions, the euro for the last 10 minutes here. So what is a currency union? It's where two or more states share the same currency. It has multiple forms. So one is an informal currency union. So this is where citizens in a country just refuse to use their existing currency, often due to hyperinflation or just because the currency is unstable. And they'll rely on foreign ones. So you see in like a lot of African nations, for example, where monetary policy has not been done very effectively, people just start trading in the dollar instead. It happened in Zimbabwe. Also happens in lots of countries generally when their economy is a bit in the shitter, people turn to a stable currency. The other one is we have a formal currency union, but without policy coordination. It's known as the currency peg. So you kind of lock your currency value at the same value as another one, but you don't share monetary policy. And the last one is common policy. This is what the euro is, which is where you share monetary policy as well as a currency. So that means for the euro, all of the countries that joined the eurozone gave up their central banks. Well, not quite, but I'll come back to that in a second. But they stopped having their central banks control their monetary policy. They all share the same currency, and that means that the monetary policy across the entire eurozone is coordinated. In some sense, the US dollar is also a currency union, and really any country that has multiple states, but there's differences. We'll talk about fiscal unions in a second. So, debates about currency union. I've done several times now the one about African currency union and why that might be beneficial. Debates about the euro are still relatively common. Debates in which the euro zone and the impacts that's had on economies, but that will be covered more in the next lecture, have come up. So what is the advantage? Why would countries share their monetary policy? The first one is it eliminates the exchange rate risk. So this is because the value of currencies tends to fluctuate relative to one another. And so if I'm engaging in business with another country, there's always going to be delay on that, right? So I agree to an order of 5,000 trucks in 2 weeks' time. If the value of my currency drops by a half in that period, my money is worth half as much as it was before to the people in the other country. Now I basically can't meet the obligation of the transaction that I made. So it causes a lot of disruptions, or it costs me twice as much as I expected. So it causes a lot of, disincentivizes people from trading across countries when the relative currency valuations change. So having the same currency across multiple countries means that I don't have to worry about that. Now, if I'm in Germany and I'm trading with Spain, I know that our money will be worth the same no matter what. It will rise and fall together. So they all operate now at the same price level. There's faster transactions. So if I want to lend money to someone in another country, or if a bank wants to move money around, it's very easy. You don't have to wait to change currency. You just send it through digitally. It creates price transparency. So now when I'm looking at producing something in Spain or in Estonia, I can be like, oh, well, I guess, sorry, Estonia doesn't have the same currency, does it? Spain and Germany, right? If I'm considering to manufacture in both, because they have the same currency, I know exactly the relative costs of each, and that means I can always engage in trade where it's most efficient. There's less risk of financial and monetary crises. I'll come on to that in a second. There's also just more cross-border trade in tourism, which sounds like a low impact. Oh, Estonia does have the euro. Okay, I thought it did. I wasn't sure. It's Lithuania that doesn't, I think. Maybe, oh God, I don't know. Eurozone expansion, I'm out of date on. Anyway, tourism is a big deal, actually, right? Tourism is like 20% of the economy of some countries. So tourism in debates about currency unions should not be neglected. People are much more likely to travel somewhere when they don't have to exchange money, because like currency exchange in its best case, usually you lose like 10% of your value when you go to the airport and you swap your money. So that really puts people off. They'd rather go to a country that has their own currency. And so the increased benefits of tourism within, for example, the Eurozone, quite substantial, worth considering in debates. Disadvantages, like we've all heard this one. Hopefully, if you've kind of been keeping up with everything I've explained so far, you might understand that things like interest rates, things like quantitative easing, things like the money supply, don't work particularly well when it's one size fits all policy. So if like Germany is booming and Greece is in a recession, well, where do you set your interest rates, right? Greece wants low interest rates. Germany wants high interest rates. You kind of meet in the middle, but this doesn't really satisfy either of them. So monetary policy doesn't work very well when different participants in the union are at very different economic levels, and this becomes particularly problematic in the eurozone, for example, because these countries all produce very different things. You've got the Netherlands, which is producing like pharmaceuticals and software and financial products and stuff like that, and then you've got a country like Hungary that's basically just doing. Sorry, Hungary is not eurozone. Spain, it's basically just producing like almost like large portion of its exports, stuff like farming, right? That means if there's a global slump in demand for one product, different countries can respond differently to it. So that's a big problem. The next one is the interconnectedness of the financial system. So for all the things I said earlier about it being easy to move money around between different countries, but it also increases the risks. So banks will tend to try and diversify their investments. So that now that they can invest in lots of countries very easily, they'll try and invest in lots of different places, so that even if like even if Spain has a recession, your investments in other countries will probably still be safe. The problem is, though, of course, that this is the theory, but it's not worked out particularly well in practice, because now the whole eurozone is coupled together, and risks in one place translate to risks in another place, and so banks now are in a position where they're all so connected that if any one country in the euro fails, banks in other countries now have investments in that country, and they'll all be affected. And there's it's called financial contagion. The other thing, as I said earlier, is now really easy to compare prices and to see how productive or how cheap things are in different countries. It's not great if you're the country that's not very competitive. Like if you're with the relatively less developed, poorer, unproductive in the economic sense country, well, now people will never buy your stuff. The capital will just move to the countries that are more productive. So this is what we've seen in the euro, right? Investment has flown to Northern Europe at the expense of Southern Europe. Even like Southern European banks are investing predominantly in Northern Europe. So it's created a lot of inequalities as a result of this. So you may often hear, this is another term I hear thrown around in debates or in casual conversation, just like, can't have a currency union without a fiscal union. And then that statement is very true, but here's the reason why. A currency union means that you share your monetary policy, but not your fiscal policy. So no tax revenue is shared, no money moves between countries. And so when monetary policy is poorly matched, that reduces the economic performance of a country. And that means that their only way of responding to recession, they can't cut their own interest rates, they can't print their own money, they can't launch their own quantitative easing program. The only way for them to prop up the economy when they go into a recession is through fiscal policy. They have to borrow money. And that means that when, in 2008, the Southern European economies went into recession, monetary policy ended up favoring the Northern European economies more because they were bigger, they were richer, variety of things. So the Southern European economies were left in a situation where the only way for them to prop up their economies was to borrow money, which meant that they ended up in a lot of debt, which meant that their economic situation deteriorated further, right? So what a fiscal union means is that you move money to compensate for the deficits of monetary policy. So when monetary policy, for example, in the USA creates mismatches between various states, there's mechanisms where the richer states will transfer money to the poorer states. What this effectively translates to is that California finances Alabama's spending, right? So they bite the bullet on the fact that they have different monetary priorities, but they compensate for that with fiscal transfers. So they move money between states from tax. So the reason, obviously, why this is easier in the USA than it is or politically easier, is that USA, all states are there's not such a big mismatch. California is like 50% richer than somewhere there like Alabama, compared to Portugal, which is like 1/3 as rich as the Netherlands. It's like much bigger gaps exist within the Eurozone. I'm going to cut it there because I know some of us have SPA around now. I'll move the stuff on Greece and the financial crisis and why Germany wouldn't let Greece default into the next lecture. Does anyone have any questions at this point? I'm going to open up mixed idea for those who are in the SPA, but for everyone else, I'm going to hang around for 5 more minutes, answer any questions people may have.
Yeah, I'm not sure I understand the problem where in a currency union, some states will be richer than others, and this like causing investment to flow away from the poorer ones. Why? I don't understand why that wouldn't just happen anyway.
So it does happen to some extent in the status quo, but and okay, so well spotted. That part was really underexplained. That's because in part 2 of this, which is when I'm going to talk about trade, I'm going to talk about fiscal stabilizers. So what happens normally is if your country is producing goods less efficiently, essentially, your economy is less productive, and that means that the value of your currency decreases. If the value of your currency decreases relative to another country, that makes investment or purchasing goods from you relatively cheaper. So currency exchange rates normally are a way of like mapping the inefficiencies of economies between one another. When you're in a currency union and those prices are stable, there's no way to compensate for the relative productivity differences between a country like Spain and Germany. So then people will always invest in Germany because there's no way for Spain to make their stuff relatively cheaper without just massively like cutting salaries or just like cutting spending or whatever. I appreciate there's not going to be a very clear explanation because that's going to be the bulk of the next lecture. But hopefully that like kind of addresses your question. Tune in next time, I guess. Any other questions? Okay, I guess, I mean, I'll stay here for a second, but if you prefer, if you come up with questions after the video comes out or just after you've had some thoughts, write them down. Tune in next time. Maybe we'll do like a Q&A at the beginning if anyone wants to recap any of this stuff. I'll do a recap of the key topics from this one that relate to the next lecture. So just as a sort of flag of the next lecture is going to be about trade, and it's going to be talking about how monetary policy influences trade. So why, for example, it's so bad that why it's so bad for countries like Spain and Italy that their monetary policy is coupled to Germany in terms of their ability to sell stuff, and why that's basically led to a breakdown for countries like Greece, Ireland, etc. within the Eurozone. So yeah, cool. Thanks for listening.
When is the next lecture?
Thank
Probably
you very much, Ron.